Since you clicked on this video, I'm going to assume that you run or have thought about running your own trucking business. It's many people's dream to have a small business they run doing something they love that supports their family for generations. In fact, the US Census Bureau estimates that around 34,000 businesses in transportation and warehousing were started alone in 2022. Unfortunately, more than 50% of those businesses won't last more than 5 years. According to the Bureau of Labor Statistics, 20% of new businesses fail during the first 2 years of being open, 45% fail during the first 5 years, and 65% during the first 10 years. And in the competitive industry of trucking, where margins can be thin, the failure rate is likely even higher. This is why it's so important to keep a close eye on your company's finances, and not just when times are really tough. If you're new to this channel, my name is Caroline, and I like to think of myself as your trucking business professor here at the Bobtail Help Desk. Our goal is to help your trucking business thrive. If that sounds good to you, please subscribe to our channel. Today, we're going to talk about finances, how to calculate your cost per mile, how to manage cash flow, and how to set up key financial habits that will help your company sustain the ups and downs of the trucking industry. So let's get into it. One of the most important aspects of financial management for trucking companies is understanding your costs. By calculating your cost per mile, you'll understand how much money you need to operate your trucks and how much revenue you need to generate in order to make a profit. So here's how to calculate cost per mile. Step 1 is to determine your fixed costs. Fixed costs are those expenses that are consistent from month to month, no matter how many miles you drive. These are things like insurance, licenses, permits, and truck loan payments. To determine your total fixed costs, add up all of those expenses that are not related to how many miles you drive. The next step is to determine your variable costs. Variable costs are those expenses that do vary by the number of miles that you drive. Think things like fuel, tolls, maintenance, and repairs. Add up all of your expenses related to driving, and that's your total variable costs. Then you add your total fixed costs and your total variable costs to find the total cost of running your business. The next step is to determine how many miles you drove. This should be a very easy output from your ELD. You should use the same time frame that you used for your costs. So if you added up fixed and variable costs over a month, go back and look at how many miles you drove in that particular month. This can be a weekly basis, monthly basis, or on an annual basis. We recommend that you keep track of your cost per mile at least once a month. Finally, divide your total costs by the number of miles you drove, and that will give you your cost per mile. For example, if your total cost was $10,000 and you drove 10,000 miles, now you know that your cost per mile is $1. Now you know how much revenue you need to generate in order to cover all your expenses. You can now make a goal for your profit margin and negotiate confidently with brokers and shippers. Tracking your cost per mile every 2 to 4 weeks can also help you identify places where you can cut back on costs. For example, if you notice that you're spending more and more in fuel, then maybe it's time to look for a fuel card or optimize your routes. Okay, now that you have a handle on how to calculate your cost per mile, let's talk about cash flow. Cash flow is the movement of money in and out of a business, and this is really critical in trucking to meet those day-to-day expenses like fuel, repairs, and driver pay. Poor cash flow management can lead to missed payments, late fees, and even bankruptcy. In trucking, cash flow management is particularly challenging because of the long payment cycles with brokers and high operating costs. One solution for managing cash flow is factoring. Factoring is a financial service where trucking companies can sell their unpaid invoices to the factoring company at a discounted rate. The factoring company pays the trucking company for those invoices minus the factoring rate. And then when those invoices come due, the factoring company collects on the invoices from the brokers. With Bobtail's factoring service, you can get your money the same or next day at a competitive factoring rate with no extra fees. You'll also get access to a dedicated support team and an easy-to-use mobile app for managing all your information. There's a link in the description to learn more about our factoring service, so definitely go check that out. Finally, let's talk about creating good financial habits. The first habit is to learn how to do a cost-benefit analysis when you're making any big financial decisions. Upgrading to new equipment, for example, can reduce your costs over time. However, it's important to understand the actual costs and benefits of a decision like this so that you can make sure that the investment is worthwhile. In the case of buying new equipment, the costs include the purchase price and any costs for financing, disposal, or maintenance. The benefits would include increased efficiency, improved reliability, and reduced downtime. To conduct a cost-benefit analysis, you're going to have to gather relevant data. That is, the estimated cost and savings over the lifetime of the new equipment. Be sure to consider all of the risks and uncertainties related to the investment, including changes in technology or the market. If the expected benefits exceed the expected costs, well, then that decision is likely to be profitable. However, if the expected costs outweigh the benefits, then you're probably going to need to look into different alternatives like leasing or renting the equipment, or delaying the decision until the costs and benefits are more favorable. The next habit is record keeping. You need to be keeping track of all of the costs and revenue generated by your business. This includes keeping a record of your fuel receipts, maintenance costs, and your invoices. Employing new technologies like an accounting software or a fuel card can make this a lot easier. Finally, another important financial habit is to pay yourself a salary. If you take nothing else away from this video, I hope it's this one. You deserve to be compensated for your hard work and the risks that you're taking. You put a lot of time, energy, and probably personal savings into opening up your business. It's only fair that you get paid for your efforts. Paying yourself a modest wage also ensures that you have the income you need to pay for your personal expenses and financial obligations. This will reduce stress and improve your overall well-being. That will make you a better business owner. I hope you found this information useful. For more finance tips, check out the guide that I wrote for our blog at bobtail.com. There, you'll also find other articles about expense management and other financial services that can help you run your trucking business smoothly. And please leave your questions about the trucking business in the comments below. Don't forget to subscribe, and I'll see you in the next video.